Well, I'm back from a whirlwind trip to San Diego to celebrate my birthday. And of course, today, let's celebrate again. It's Fat Tuesday. Markets are celebrating by being up for a third straight day in most cases. However, there is one index that continues to lag behind. So we're going to explore that, possibly take our trade example from that lagging index here today. So let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It is February 13, 2018. Great to have each and every one of you on board here today, whether this is your first time or whether you're a longtime viewer of David and I's videos. Remember that on YouTube you have the ability to subscribe to our channel by clicking on that red button. You can also click on the bell icon there, and that'll notify you anytime we upload these videos to YouTube. In addition to that, if you want to encourage us to continue to make these videos, we would encourage you to click the thumbs up button underneath the YouTube video. In addition to that, you'll find that there's a comment area down towards the bottom where you can leave some comments for us. And lastly, there's a description area where you can find some helpful links, including a link to sign up for our daily distribution list, where we can also let you know which stocks are giving you oversold or overbought cluster signals. Now, in addition to YouTube, we're also heavy users of Twitter. My Twitter handle is @BrandonVanZee, all one word, so I'd encourage you to follow that. Follow the Market Scholars handle as well, which is @Market_Scholars, and also follow David Settle while you're at it. All of us will contribute to your Twitter understanding of the financial markets. So if you want to stay on top of that, make sure you're following those and doing your best to like and retweet these Market Outlook tweets on Twitter as well. Now, in addition to Twitter, we're also on Facebook, and we'd invite you to join our Facebook group. You can see the web address on the screen in front of you there. All right, so let's go ahead and tackle the markets here. As you can see, I do have the S&P 500 pulled up in front of us right now. And as mentioned before, we are now completing our third straight up day for that S&P 500. You can see today's final close was up by 6.94, good for a 0.26% increase there. So maybe not quite as wide of a range from high to low as we've seen in recent periods, but still good again to see some stabilization. A couple weeks ago, things got a little chaotic, a little too quickly for most people in the market. So it's good to see this stabilization come nearly as quick as the fallout in the market as well. We'll see if that continues or not. Obviously, we're a long ways away from our previous highs, but the good news is we're also a fair amount higher than the lows that we had here recently as well. Now, I mentioned Twitter before. One thing that I would point out here, some of you caught this, on my Twitter feed, it's again @BrandonVanZee. Make sure you're following me there. But it was on Friday when the market was bottoming. And if I could find that tweet, I'll point it out right here. So I was kind of talking about this idea of looking for a flush the toilet day, because we haven't found a bottom up until that point on Friday yet. But I caught this moment here, and maybe it was just luck, I don't know. I don't do a whole lot of short-term tweets, but if something catches my eye and something just feels a little bit off, I'm going to do my best to share that with you guys. And David does an even better job than I do when it comes to that. And so make sure you're following both of us if you want insight intraday, not just at the end of the day like these videos are. But I kind of pointed out that what we're looking for is that flush the toilet moment where they're taking out all of the stop losses, and it looks like there's nothing but blood and death in front of you, and then they pull the rug out from underneath you and they rip the markets right back higher again. And that's kind of what we saw here. You'll notice that when I tweeted this out, this again was on Friday morning, notice that the ES futures, which is a way to track the S&P 500 through the futures market, was at about 25.48 at that point. And you can see kind of down below here what that looks like. We had this cascading effect that was taking place. We put in this early kind of bottom here that held for quite a few hours on Friday, but as soon as these candles started coming through here, notice the pickup in volume. And I know this is kind of hard to see because my tweet text keeps on popping up in front of it. But if you'll notice kind of to the left of where my cursor is right now, there's a bunch of gray. That's the volume. You can see that a lot of that volume was picking up as soon as we crossed those lows. So I was really anticipating that we would be able to find some sort of, rally back the other direction, as the market maker's job in a lot of cases not only just to provide liquidity, but it seems like just to frustrate traders as well. So as all those other traders are getting stopped out of their positions left and right, and we got stopped out of some of our positions in our top-down trend trading account as well, so my senses are already heightened to this possibility. We actually did have that, and lo and behold, it was only, where was it? Right here, 11 minutes later, that 1.7% loss when I had that previous tweet was erased in just 11 minutes after that. So I can't promise you that that's going to happen every time I tweet something out, but it is good to see that it worked this time around. All right, hang on just a second here. All right, so let's get back on track here. And the main takeaway is make sure you're following David and I throughout the day on Twitter as well if you want to stay on top of what catches our eyes, peculiar movements in the market, or just interesting news items that might affect the way that we're thinking about the markets. Our outlet, think of Twitter as our diary. It's a way for us to put into, on paper, so to speak, what we're thinking about the markets at that moment in time. And so if you're newer to the markets, you might benefit from having that insight. All right, back on track. As we take a look at the S&P 500, mentioned before, we do have another update here, and we do continue our weekly bullish posture. Now, we're not out of the woods yet, so I want to make sure we're clear on this as well. It's good that we found a tradable bottom. We're up about 5% from those areas where I was talking about it on Twitter there, and so that's a good sign. But I don't think we're completely done with this indigestion of the market, so to speak, that we've had here recently. So we just have to stay a little bit more alert during these periods than in the past, when it seemed like the coast was always clear and we always caught a higher bid to the upside. So as we stand right now, we do have a slightly bullish posture. We're at 26.38 and rising if you're using that intermediate term line, the green line on the market forecast tool, as your bogey. As we take a look at a couple of other charts here, let's go ahead and take a look at our foregrid. And this is what I was mentioning in the intro. There's one index here that, of course, stands out, and that's your Dow Jones Industrial Average. That's the index in the upper right of these four charts. And the reason it stands out, of course, is that its background color is pink. And what that signifies is that we have a bearish intermediate posture using the market forecast tool. Now, on this one, you can see right here, the intermediate term line is at 29.02 and falling. And so that means that if the reading is between 80 and 20 and it's falling, that means that we would consider that bearish. Whereas the other ones are just hanging on for dear life to a little bit of bullishness. You can see again on the S&P 500, 26 and rising, down here on the NASDAQ, 29 and rising, and down below here on the Russell, 23 and rising. But you'll notice that if you just kind of glance at the green lines themselves, they look like they're more flat than actually trending up. So we don't want to make more of this than it actually is. So as it stands right now, be aware that the only index that does not have a red tip when you're using my charts here is the NASDAQ on the moving average. Notice that the tip of the moving average here is actually yellow. And what that signifies in this case is that although we have price below the moving average itself is rising. So it's kind of a neutral signal. Whereas these other tips are red, and what that signifies is the moving averages themselves are going down and prices below those falling moving averages. And so when we have conflicting signals like we do right now, because some of you would say, okay, well, the S&P 500 says that we should be bullish according to the market forecast green line, but price action may dictate that you remain somewhat bearish or at least neutral because price is below a falling moving average. Then it might make sense to focus on the Dow Jones today for our trade idea, because then you've got all things kind of lining up together. You have bearish posture using that green line here, and you have price below a falling moving average at this point as well. So we'll take a peek at that as our trade example here a little bit later. But before we do, let's go ahead and pop on over here to a couple other charts along the way. This next one here is going to be our 3 green arrows chart. It's going to be the same 4 indices here in the United States. In this case, it's a mixed bag. You can see the charts on the right, in this case would be the Dow Jones and the Russell 2000, both have pink charts, and in this case that means that they have 3 red arrows. You can count them out here. There's our first red arrow on the Dow Jones as price crossed below that moving average. We have a second red arrow down below here on the MACD, telling us that we have a loss of momentum. And then we just got this phantom red arrow right here on the stochastics, or a turn back lower on the stochastics after a brief move up. And that tells us that the bears are now in control of the ball again. So again, one more reason to remain maybe slightly bearish on the Dow Jones, whereas we're starting to see maybe some healthier signs amongst the other indices here. Remember, when you have a white background like we do with the S&P 500 and with the NASDAQ in this particular chart setup, it just means we have mixed signals. And so as a quick example, we have a red arrow on the moving average for the S&P 500, a red arrow on the MACD, but we do have that green arrow down below on the stochastic, so that's not necessarily lining up right there. All right, moving on now to our next chart. This is going to be our longer term view of markets. This is what we call our 1040 crossover method, and what we're looking for here are crosses of moving averages. We've got a 10-period moving average on each of these 4 charts represented by the orange line. We have a 40-period moving average represented by the black line. Each one of these candles represents 1 week in time, and these charts all go back 3 years in time. And so what we're looking for here are major swings in one direction or another. We realize before we even implement this strategy, we're not going to catch the ultimate top to sell, and we're not going to catch the ultimate bottom to buy. What we're looking for is to ride the trend as long as we can and not get kicked out of that trend unless there's some major disturbance. Now, obviously, the last couple of weeks has been a fairly serious disturbance, but we haven't actually seen the crosses of the moving averages yet. The one that we're getting closest to on is going to be the Russell 2000 down here. Notice that orange line is pointing down now, heading towards that black line, but we're still haven't crossed it yet. So we're going to keep our eye on that developing story as the weeks and the months develop, and we'll of course let you know as soon as we see the crossover take place as well. So keep on watching these videos. All right, let's now take a look at our sectors. This is our 12 grid, so this is where I'm going to kill the camera feed, and that way we can see all 12 of these on the screen in front of you. Now, as a reminder, your chart in the upper left is the S&P 500. The 11 charts that come after that are going to be 11 different major sectors that make up the market. The interesting thing is that we have a mixed bag here. You can see that the S&P 500 itself is a green chart, meaning again that we have a bullish posture, weekly bullish posture. And with the S&P 500, you find that the industrials, XLI, in the upper right. We also have technology off to the left in the middle. We have telecom, and we have financials. Those are our 4 bullish sectors as it stands right now. But you can see that we have more bearishness at this point, despite the fact that the market itself would be considered bullish. And so one thing to remember with that is that not all sectors are created equal. Technology, financials, and industrials are, I think it's 3 out of the 4 largest sectors that are out there. And so they're very big, not only from a market cap perspective, but they're very big from a components perspective as well. They have the most components within them. So they're maybe masking the fact that the market is probably struggling a little bit more than it might seem at first blush. Right now we're saying, okay, well, the S&P 500 has a bullish posture, but it may just be because the biggest sectors are are holding up their end of the bargain, but on an equal weight basis, it may not be quite as rosy as you might expect. Because as you see up here, we've got energy, we've got materials, we've got discretionary, we've got healthcare, we've got actually staples, we've got utilities, and we've got real estate, all with pink charts, telling us that indeed we still have bearish postures on all of those. And as I look at the moving average tips, I don't see any green tips anywhere. I do see some yellows, but mostly we have red. So again, we're still in kind of a cautionary position as it stands right now. We're not wildly bullish here. All right, moving right along now to our foreign markets 12 grids. Let's see what's going on in the world around us. And here we're finally starting to see a few more of those green lights pop up. Remember last week we saw a clean sweep with pink charts across the board, was with the foreign markets. So we have had some time for stabilization, and we find that India is trying to stabilize. It went green. We also find that Australia did go green, and then South Africa went green. But again, notice we have a red tip, we have a red tip, and we have a red tip. So moving averages trending lower, prices still below moving averages. It does look like South Africa will be the first one of those three to get rid of that red tip and turn it back into a yellow tip if we could get price above this moving average here. And that could happen by the end of this week at this point. You can see how close it is already, whereas Australia is still a long ways away from its moving average. We also have India a long ways away from its moving average. All right, so let's take a look at our final 12 grid here, which is our Intermarket Analysis 12 grid. And as you can see, kind of a mixed bag here as well. Volatility has been the big story here recently. So that's our chart in the upper left. That's our VIX up there. And you'll notice that we had another down day for the VIX. Makes sense. We've had 3 straight down days for the VIX while we've had 3 straight up days for the S&P 500. Remember, those two are typically inversely correlated to one another. As we look at the bullish charts that are out there, interest rate yields continue to be bullish. Now remember, that helps support the financial companies, and you'll recall that XLF was one of the few bullish sectors in the S&P 500 right now, so that makes sense. We also have preferred stocks, maybe somewhat surprisingly, turning green here, and you'll also find the dollar does have a green background chart as well, although I don't know how healthy this is, because you can see that we had this kind of reversion to the mean move here on the dollar, and it does look like it's bumping its head on that moving average and wants to roll over. In fact, let me right click and go to maximize sell, and let's review that in a little bit greater detail here. Here's what I was referencing before. We had this reversion to the mean back higher, kissed that moving average, and moved down right there. So despite the fact that we would consider this bullish because the green line is barely trending up, it's pretty flat, but it is still drifting a little bit higher there. So we would consider this bullish, but looking at price action, I don't know how aggressive I would be with that bullishness at this point. All right, so that concludes our 12 grids here. Let's take a quick peek at what sectors did the best on a daily basis here. So I'm going to go to Market Watch and just kind of sort this by mark percent change. And you can see that the best performer today was actually real estate. And that's been an area that's really been beat up here recently. Worst performer, energy, down 0.55%. Not far behind it was XLB, which is materials. And remember, those are your late cycle types of sectors out there. Generally, those will do really well once the market starts getting to that point where it wants to truly top out. So if we do have a rally in us, and I think if you listen to David Settle's video last night, his expectation is that we will have higher markets by the end of the year. I wouldn't be surprised myself by that. And if that does happen, remember, we're so far into this bull market, 9 years or whatever it is at this point, that if we are going to anticipate a rolling over of the market at some point in the future, let's look for the leadership out of energy and out of materials if you believe in the whole business cycle. And so Right now, we're not seeing that. Of course, today does not make a trend, but we do see that those were some of the lagging areas of the market here today. If we were to take a peek within those areas, let's take a look at real estate first. Real estate was the area that led the market here today from a percentage perspective. We had CBRE Group that was up 2.29%, and then we had Extra Space Storage, which I believe is based right here in Utah. Ticker symbol EXR was up 2.2%. If we look at the energy laggards here today, let's see, who did we have on the downside? We had Chesapeake on the downside. We had Baker Hughes, a GE company, down over 3% as well. Devon, Hess, and Occidental all down over 3%. So energy taking it across the chin here for the day. All right, let's now move on to our trade example for the day. And so, as mentioned before, I wanted to kind of pick on the one index that has struggled to keep up with the rest at this point. You know, I've mentioned in the last two market outlook videos that I did that I wouldn't be surprised at all if we have chop and slop sideways for a while as we try to determine which direction the market wants to go. Maybe we have a tradable bottom that was put in last week, so we're thankful for that. And clearly the top is a long ways away as well. So, you know, we might find that we're stuck between those bands for the next couple of months. And so with the markets up for 3 straight days, you know, a swing trader might be thinking to themselves, okay, well, it's about time for the bears to take back control. This might not be a trending up or a trending down market anymore. It might very well be a chop sideways market. And so that's the type of environment where you sell the rips and buy the dips. Well, we've just had a rip up by 3 days here, and volatility remains fairly high. Even though volatility has fallen for 3 straight days, it's still at a much higher level than where it was a month ago. And so we can think about doing some selling strategies when volatility is high if you anticipate that volatility will ultimately drift lower yet again. And so what I wanted to do here today was a bear call spread on DIA. And so let's go over here to the trade tab. And I've got the March contracts pulled up. These are the ones that have 31 days until expiration. That's as of right now, the 13th of February. And as I come out here, let's go over to the deltas, and you can see that there's some deltas that are close to 30. That's usually where we start our approach. Now, I did look at the 29s before doing this video, and I found that I could actually go one more out and still be satisfied to the 26 delta in this case, which would lead me to the 254 to sell. Remember, volatility is inflated right now compared to where it typically is. So it will allow you to do one of two things. Either keep the same strikes you normally would when volatility is lower, but receive a bigger reward, or allow you to kick your strikes, your break-even strikes, further away from where you're at here currently. And so that's the approach that I'm going to use right here. Rather than going with the 253, I'm going to use the 254 as my sold strike, and we'll do it a $2 wide and go 256 as my long strike on the call side. Remember, this is going to be a bearish trade here. So if I right-click on the 254s and I go to sell vertical, and then I can change it from 255 as our bought strike to 256 in the order entry area itself, notice that the credit that we'd receive is about 51 cents here. So for those of you that are newer to options trading, what I'm basically saying here is, all right, with the DIA at 246, and remember this is the ETF that most closely tracks the Dow Jones Industrial Average, with that currently at 246 at close today, I'm going to allow it to go up to 254 between now and expiration, 31 days from now, and still make money on this. So while the posture right now on DIA is bearish, and that's really the driver of this trade, we could certainly see that DIA could go sideways for the next 31 days, or it could certainly even go up $8 per share, and we would still be in decent shape with this trade. Now, if it rips higher, if we go right back to all-time highs within the next 31 days, then we will lose money on this trade. But the good news is this is a defined risk trade, and that's why we're buying the 256 as part of this trade. All right, so If we take a look at our chart, so again, remember 254, and we're going to take in 51 cents for doing this trade. So really our break even is 254.51. If we look at our chart, 254.51 is about right here, somewhere right in there. I can't look at it exactly, but where my mouse is pointing right now is right in the neighborhood of where our break even would be on this trade. Now, hopefully most of you are identifying the fact that we have that 30-day moving average right in that neck of the woods. Oftentimes you will find that those moving averages can act as support or resistance. And so if we do find that this market decides it wants to keep on going up in the next couple of weeks, it's entirely possible it gets up to that moving average, kisses it, and moves right down off of it. You know, kind of a reversion type of a move. So let's go ahead and place that trade here. And by the way, if you ever wanted to calculate what your return on risk is, you can get your calculator out here. And if you click on confirm and send, it'll show that in doing just one contract here, again, position size for whatever makes sense for your account. We're not here to tell you what's the best for that. But in this case, we're just going to do one for practice purposes. So we would make $51 here. And our max loss, if things go terribly against us and the stock market just skyrockets from here, our max loss is $149. So let's divide 51 by 149 to see what our return on risk is. So 51 divided by 149 means that we have about a 34% return on risk. And typically, David and I are shooting for about a 30% return on risk or higher. So this one easily clears that hurdle here for us. I'm going to again confirm and send here on Paper Money and send that one off. So that'll do it for the day. Certainly appreciate you guys checking out these videos as always. Remember to subscribe, like, comment, sign up for our email distribution list, and also make sure you're liking and retweeting on Twitter for us if you want to continue to get these insights from David and I going forward. All right, with that, I hope you guys have a great rest of the night. David will be with you again tomorrow, and then I'll be back with you on Thursday. We'll see you then. Take care. Bye-bye.